Well, Danai, we are finally here.
Yes, Nephili, we are finally here. Before we go on, we just want to remind everyone that the information provided in this content is for educational and informational purposes only and should not be taken as financial or investment advice. We are not licensed financial advisors. Always do your own research and consult with a qualified financial professional before making any investment decisions. Now that we go this out of the way, let's recap what we learned so far in our previous modules. We learned why it is important to be invested, why we need to start early. We learned what are stocks, bonds, ETFs, and who are the different online brokers we can use. Now we can put our finger on exactly what portfolios we could build. This is such a key thing and one of the most important steps in investing. You may hear the terms asset allocation or capital allocation or investment allocation, which essentially all mean which stocks, bonds, ETFs, and others we select.
Exactly, Danai. It's time to say what we buy and why. It's a bit of a nerve-wracking phase, but we will get there. We are well prepared. I have to admit, this is the module we spent quite a bit of time researching more than others.
That's right, Nephili. This is what I feel too. It's one of those moments in life where a lot of people spend a lot of time before a decision, but have a lot of difficulty making the move on one of the options they listed. This is why we wanted to understand each option carefully, as this is something we select for the long term. The good news is that we have a lot of time ahead of us, and it seems that all the experts converge on the same strategy for young people like us.
Let's take it step by step and try to make it as simple as possible. The first thing we have to decide is what our risk profile or risk appetite is. This is quite personal, and it will be different from people to people. It depends on what stage in life we are and what our financial objectives are. For Gen Z like us with many years ahead of us, we would typically be willing to take more risk. Why? Well, as history shows, even if there are some bad years going forward, we can withstand that, as there is always recovery. On average, we would gain in the long term. On the other end of the spectrum, a person who is in retirement would want more safety. They would want to preserve their capital and maybe derive more income from the investments rather than have capital appreciation. Somebody in the middle that has a family may want to build money for retirement. At the same time, they want to take a more balanced risk because they may need to withdraw some money in cases of emergency. So how do we build portfolios of different risk profiles? There is an abundance of examples from various sources such as Investopedia, Vanguard, iShares, Fidelity, and many others. They are all quite similar. We include the links on our website so people can spend time to study them. Let's look at the Fidelity example in more detail. 3 different profiles ranging from conservative to aggressive growth. You can see that the main varying factor is the mix of stocks versus bonds. On a secondary basis is the exposure of international stocks versus U.S. stocks. To derive the exact percentages, some people also use the age rule. By subtracting your age from 100, you find the percent of stocks you should include in the portfolio. However, since people live longer nowadays, there is a debate whether we should be using 120 instead of 100 in the rule.
This is great background, Nephili. Let's give it a shot now to define our own model portfolio. First, we start by selecting the type of ETF and then the geography that we would like to focus on. Note that we only talk about ETFs, not single stocks or bonds. We want to diversify, and we don't have the knowledge and time to analyze and choose from the thousands of stocks. So we simply select a number of stock or equity ETFs and a number of bond ETFs. Please note that the word stock ETF or equity ETF is used interchangeably, so don't get confused if you see them on any investment site. The other thing you may see on investment sites are some other asset classes like real estate, commodities, multi-asset, but we will not discuss those in this module. These can be choices for more advanced investors and not really required to start with. For geography, we may select US, Europe, international overall, and so on.
Okay, Danai. We prepared 3 portfolios with varying risk profiles that anyone can use. The first portfolio is called conservative. This is for people that give more emphasis to preserve their capital and want to generate some income at the same time. These people don't want to sustain large short-term volatility on the value of their investment. The second portfolio is called balanced. This is for people that aim for a mix of preserving their capital, but at the same time they would like to have moderate capital appreciation. They may also aim for some income generation. They are comfortable with tolerating some short-term volatility in prices as they have mid to long-term investment time horizon. The third portfolio is called aggressive. This is for people aiming for dynamic growth through capital appreciation. They are willing to tolerate large short-term fluctuations in prices as they have a long-term investment horizon. Generating income is not typically a priority.
So based on these definitions, the allocations for the 3 model portfolios we prepared are shown here. As we can see, the main varying factor is the percent of stocks versus bonds. In the previous modules, we saw that stocks are more volatile and may experience large short-term fluctuations, but they have the highest potential to appreciate in the long term. They are therefore more risky in the short term. Bonds, on the other hand, are more stable, and if they are government-backed or investment-grade for companies, they offer a better safety net. They also produce income, coupon interest, which can be quite significant for some people with large sums allocated to this asset class. The secondary factor is the allocation we do geographically. The U.S. has always been one of the largest and dynamic economies. It represents about 25% of global GDP, and U.S. stocks also represent 45% of the value of all global stocks and have occupied a big chunk in portfolios from investors around the world.
And lately, Danai, due to the tariff debates, many professional investors are recommending to diversify further into global and European stocks. Nobody knows, of course, how the world trade order will unfold over the next 10 years. Emerging markets is also another sector that can be included. This includes upcoming developing countries that historically have been contributing to long-term growth. Countries such as Argentina, Brazil, China, India, Indonesia, Mexico, South Korea. Let's keep things simple, though, and assume a good representative of international stocks, ex-USA. The ex-USA indicates that they exclude U.S. stocks. It took us a bit of time to select these ones as the choice is a bit limited for us European. One can change the allocation based on developing events. Now we have to put the specific ETFs that would match this portfolio.
We prepared a big menu of applicable ETFs from which we can select and would allow us to build a number of different portfolios. We studied a lot of the potential options from Vanguard and iShares, but, as we covered before, we focused only on UCITS-based ETFs. This makes the research more cumbersome as the options for European investors are more limited compared to the US market. However, it seems that year by year the list is extended. Remember that in our ETF module, we said that for us Europeans, it is important to select the UCITS-based and not buy the US equivalents. In any case, many of the online brokers will not allow individual investors like us buy US-based products for regulatory reasons. Only professional investors may be able to do it. We are not going to go through the full list here, but you can view and download it from our website, so don't worry if you cannot read it here.
Let's pick up now the specific ETFs that match the requirements of the model portfolios. Here is the result. We selected ETFs from iShares, but the same result can be achieved with Vanguard or a mix of the two. We just found it easier. CSPX covers the US stocks via the S&P 500 index. XUS covers our international exposure without any US stocks. IUAE covers our US bonds, which includes both US treasuries, so government bonds and corporate bonds. AGGH covers international bonds, both government and corporate. There could be some variations of the symbol, depending what you choose on your platform as currency, or whether it is accumulating the dividends or distributing them. So make sure you choose the one that suits you.
Only 4 ETFs. This is great, Nefeli.
Yes, Danai, that's right. Of course, people can select a different mix and add other ETFs if they think this will add more value, but we promise to keep things simple and effective. But we will show that these are good enough to deliver the performance expected.
Yes, exactly. That's why we did the so-called backtesting. Backtesting means that you can simulate how these selections would have performed in the past. Of course, this does not mean that it can be repeated in the future, but it is a good tool to provide some perspective. There are many free backtesting tools one can use. We used Portfolio Visualizer. We had to use the US equivalent ETFs as the UCITS ones do not have a long history. This is okay as they contain the same more or less stocks and bonds. We did it for 10 years, but one can choose to do it for much longer. We can see from the results the difference between the different risk profiles. In our case, Nafili, we chose the aggressive portfolio as we are aiming for dynamic growth. We are young, we are long-term investors, and we are okay to experience any short-term volatility. And just to summarize, here is a table with all the choices and percentage allocations.
Yes, Danai, that's right. We make our choices and we let it run. We only need to review once a year for any changes to the allocations that typically shouldn't be that significant. This chart from Vanguard is quite interesting. It shows from the various allocations of stocks versus bonds what the potential annual returns may be, but also the volatility one can experience during this long period. The period they simulated is from 1926 to 2022. Our portfolio returns are within these bounds, which is a good check. We also like this tool from iShares, which although it is US-based, nevertheless is good for education purposes to see how allocation plays a role. You can vary the slider and see the different allocation chosen.
So here you have it. We should not forget that we invest money based on a dollar cost average method, meaning that we select an amount and we just buy these ETFs month by month. Nobody can tell if the market will go up or down, so this is the most sound strategy for us Gen Zs. Let's all spend the time to get more educated on investing and make the choices most suitable for our goals. Happy investing, everyone!
Happy investing, everyone!